In a little over a week, FTX went from a multi-billion-dollar crypto exchange to filing to bankruptcy in the United States. In a system as delicate as the blockchain, just one report took down a crypto giant and changed the legacy of its founder forever. From the king of crypto to a kingdom in ruin, this is the dramatic fall of FTX. On Tuesday, the 1st of November 2022, it was business as usual for FTX. And with an estimated valuation of $32 billion in January of that year, business was good. With celebrities the likes of Steph Curry, Tom Brady, Gisele Bündchen, and even Shark Tank's Mr. Wonderful himself attached to the brand, everything about FTX seemed right and above board. After all, who wouldn't trust the brand plastered across the Miami Heat stadium with their money? Despite a smattering of scandals and controversial reports against the brand over the years it had operated, FTX remained one of the largest cryptocurrency exchanges in the world. Then, in the course of a week, that all came crashing down. One report, one decision, and one crypto empire forever marred. Samuel Bankman-Fried wasn't born a billionaire, though he would go on to claim the title of the most generous of them all. He was born on the 6th of March 1992 on the campus of Stanford University to law professors Barbara Fried and Joseph Bankman. With an aunt serving as the Dean of Columbia University's Joseph L. Mellman School of Public Health and a former Wall Street trader for a brother, there was no doubt that Sam came from an impressive family of affluent academics. Sam would go on to follow in their footsteps, and after a childhood spent in California, he relocated to the East Coast to attend the Massachusetts Institute of Technology. In 2014, after 4 years of living in the coeducational group house Epsilon Theta, Sam graduated with a degree in physics and a minor in mathematics at the age of 22. The summer before graduation, back in 2013, Sam began his professional career through an internship at the proprietary trading firm Jane Street Capital. There he worked as an international ETF trader, a position that he returned to the next year following his graduation. He would remain at Jane Street for a total of 4 years before leaving the company to move back to California, settling in Berkeley, where he had a short 2-month stint as the Director of Development at the Center for Effective Altruism. Though his time at the CEA was short, it was there that Sam met Tara McAuley, with whom he would co-found Alameda Research the same month he left his Director of Development position. Alameda Research was founded in November 2017 as a quantitative trading firm. By January 2018, just 2 months later, the company was dealing with upwards of $25 million a day in the cryptosphere. 2 years later, Sam, along with former Google employee Gary Wang, founded FTX within Alameda Research, though it quickly separated to become its own entity. FTX, an abbreviation of Futures Exchange, officially began operations in May 2019, and though there was darkness on the horizon in the years to come, the company would go on to achieve great things. Between its founding in 2019 and fall in 2022, FTX acquired a bunch of companies and attracted tons of sponsors. Within 6 months of FTX establishment, Zizi, the CEO of the world's largest cryptocurrency exchange, Binance, purchased a 20% stake in the company. From that point on, FTX was minting money. By 2021, FTX was valued at $18 billion and had raised a cool $900 million from investors like Sequoia Capital and SoftBank. That same year, the company bought back the 20% stake Binance had purchased the year prior, exchanging it for a none-too-small amount of FTX's native token, FTT. In late 2021, the company shifted its headquarters to the Bahamas from Hong Kong, where Sam had relocated after starting the firm. The company was at its peak in 2021. With over 1 million users on the platform, FTX had become the third largest cryptocurrency exchange in the world. Though their upward trajectory would continue well into the next year, as the saying goes, what goes up must come down. At the end of January 2022, FTX raised a total of $400 million in Series C funding, valuing the company at $32 billion, nearly double the previous year's $18 billion valuation. The year involved big dreams and even bigger goals for the company, announcing the introduction of stock trading for their American customers, and even a gaming division dedicated to developing the integration of cryptocurrency and the blockchain into video games. However, the first sign of trouble came in August of 2022. when the Federal Deposit Insurance Corporation issued a cease and desist letter alleging that FTX had been making false and misleading representations regarding whether FTX funds were insured by the United States government. These allegations were of a tweet made by company president Brett Harrison, who deleted the tweet in question following the letter. Sam followed up in a tweet of his own, clarifying that FTX was not in fact insured by the Federal Deposit Insurance Corporation. Although the brief scandal was relatively unrelated to what was on the horizon for FTX, it was the first in a series of problems for the company that would see the end of FTX as the world knew it. The second came just 1 month later in the form of a Bloomberg report in September. Bloomberg noted that Alameda Research and FTX, sister companies founded by Sam Bankman-Fried, shared an extremely close relationship, dubbing Alameda as a market maker for FTX's early days. The report highlighted that Alameda had remained FTX's largest depositor of stablecoins mid-2022, a relationship which wouldn't have been permitted in traditional equity markets such as the stock market. Simply put, the relationship between Alameda Research and FTX through Alameda's trading on the cryptocurrency exchange allowed for Alameda to occasionally make money while others lost money on FTX. Despite this, Sam was quoted defending the relationship, stating that it created liquidity for FTX. For those whose days in high school economics are far behind them, liquidity is a company's ability to exchange an asset for cash. The report by Bloomberg, though it did warrant a response from Sam himself, didn't cause nearly the level of catastrophe that a similar report, made months later, would. The final blow was dealt in a straightforward report made by Ian Allison, an author of CoinDesk, an online news platform specializing in Bitcoin and other digital currencies. On the 2nd of November 2022, CoinDesk published a report stating that a significant chunk of Alameda's assets were held in FTX's native token, FTT. Alameda was reported in June of 2022 to have a total of $14.6 billion in assets. Of those billions of dollars, $5.1 billion, nearly a third of their total, were held in FTT tokens. CoinDesk states that the report came from a leaked balance sheet that showed Alameda's dependence on FTT. Binance CEO Zizi then took to Twitter to announce that Binance would be liquidating all of their FTT holdings, due to recent revelations that have come to light. His following tweet sought to assure the public that Binance would try to execute the liquidation in a way that minimizes market impact over the course of a few months. Despite Sam's attempt to assuage concern through his own series of tweets the following day, Binance's decision did in fact affect the market. Bloomberg's report that any sale of FTT by Binance would greatly lower the price of the token, coupled with the price decline as a result of Sam and Zizi's public exchanges, spurred on a bank run of $6 billion that sent FTX deep into crisis. FTX didn't have the liquidated money to fund the mass withdrawals. On November 8th, just a day after Sam tweeted out that FTX is fine, assets are fine, Binance stated that plans to acquire FTX were being made. However, they would decide against it just the following day. Without Binance to bail them out of the liquidity crisis they had found themselves in, FTX suspended all withdrawals and halted the taking on of clients. On November 10th, Sam took to Twitter to take responsibility for FTX's shortcomings, indicating that the company was seeking capital to remain afloat. Later that same day, FTX's subsidiaries around the world had their assets frozen and placed under administration. The entirety of the FTX Futures Fund's management team that ran FTX's charity, that had donated $160 million as of September 2022, resigned from the company on that day as well. On the 11th of November 2022, 9 days after the publication of the CoinDesk report, FTX filed for bankruptcy in Delaware, allegedly owing up to $8 billion. In less than 2 weeks, FTX went from one of the biggest crypto exchanges in the world to a bankrupt company with a broken reputation. Sam Bankman-Fried, once known as the world's most generous billionaire for his millions of dollars in charitable contributions, now sits on the throne of a ruined empire. Whether or not the company ever recovers, the world of cryptocurrency has forever shifted into a more cautious one in the wake of the fall of FTX.